All right, welcome. Today, we're going to be discussing a variety of subjects like we oftentimes do: homesteads, notes, lending, and subdivisions. That sounds like just an exciting mix. And for those of you that are new to this, the material that I present is really designed for passing the California real estate licensing exam. Right, I'm not really just going through all of the principles of real estate or that sort of stuff. So if it's something we know the Department of Real Estate wants you to know, we're going to talk about it. And if we don't think they want you to know it, we're not going to spend much time on it. And we're going to start with something called the homestead exemption. Now, when I say the word homestead, what comes to mind? For some people, it's like, out on the prairie, somebody has like a little log cabin, their homestead. Back there's these old movies, right, where they would have all these people lined up, at some boundary, and they were opening up a new area. And so there was people on horses with, wagons and things like that. And somebody would fire a gun for the start, and everybody would go, running into the area, and they would find a piece of land and they'd put little stakes around it and build a log cabin, right? But yeah, that's not what we're talking about, right? We're not talking about homesteading in that sense. We're talking about protecting a home you already have. And the purpose, it says here, of the homestead law is to protect a person or a person's family's residence from certain types of creditors. It allows debtors and their families to remain in the home in some situation, even when a sale could pay off the creditors. And a homestead is protected from forced sale by certain creditors. This is probably a more thorough explanation. To the extent of the homestead exemption, which we're going to talk about later, which is the amount of equity that is protected by law. A judgment creditor cannot force the sale of a home unless two things occur. One, the homeowner gets their exemption, and two, that any and all prior liens will be paid. Now, what's going on here is when we say certain types of creditors and a judgment creditor, what we're referring to is somebody who has been sued in a court of law for damages. Typically, people get sued because of business issues or medical issues. You run up hundreds of thousands of dollars in medical bills and your insurance doesn't cover it, or you don't have insurance and the hospital sues you and they get a judgment against you for $500,000. You have a business and the business fails and you owe all these creditors, you owe all these people money, which you cannot pay, and they sue you and they get a judgment against you. So that's the types of creditors we're talking about. We're not talking about a mortgage. We're not talking about a trust deed or a tax lien. We're not talking about an IRS lien. Nothing gets rid of those. We're only talking about judgments. So this is the theory. If somebody sues you and gets a judgment against you, they can take your assets, money you've got in the bank, personal property, jewelry, expensive paintings, an expensive car, but we ought to make it harder for them to take your home. And so what the homestead law says is that if you're going to take somebody's home, you have to make sure that they get a certain amount of money. And if they don't get that amount of money, then you can't take their home, right? That's the whole idea. Now, there's two kinds of homesteads. There's the residential or the automatic. The automatic or the declared. I'll explain later what the difference is. So my metaphor for a homestead is like having an umbrella. Actually, it's more like having half of an umbrella. And if it's raining, it would be better to have half of an umbrella than no umbrella at all. Now, the half of the umbrella that works is unsecured judgments. An unsecured judgment would be like you owe medical bills, you owe money in a business failure. And secured, it does not protect. The part that is missing are secured or prior liens. Mortgages, trust deeds, mechanics liens, tax liens, those are secured liens in that the property was actually put up as security for the debt. In the medical bills or the business failure, the property wasn't actually volunteered as security for the debt. There's just a judgment. Notice it also doesn't protect against prior liens. What that means is that if it's already been raining, it's kind of late to put up the umbrella. So judgments that are already against you before the creation of the homestead, or judgments or secured liens are not covered by the homestead, not protected. It provides protection against subsequent, that means later, unsecured creditors, and that means judgments. You can only have one property homesteaded at a time. And if you have two, one of them will be invalidated by the second one will be invalidated. So in order to have a homestead, number one, it could be just an automatic. So if you're thinking, boy, I better go get myself a copy of the homestead exemptions and the homestead forms and file them, you can do that. But if you have a private residence, it's already automatically homesteaded. It's just already covered. I'll explain a little bit later why you might declare one. Right? For example, if you, well, I'll say it now. If you live in one city and you're moving to another city, remember you can't have two. So you might have to abandon one and declare another one. But anyhow, the declaration of homestead, that's actually a form. Google searching declaration of homestead in California will provide copies. They might be in your principal's book or whatever, but you know, you're never going to use them again. First of all, you have to have a statement that you're the head of the family. If married, the name of the spouse. Now, the Department of Real Estate once asked, more than once, they've asked on the state exam, could a husband or wife record a homestead without the other spouse's knowledge and consent? And if they were to do that, would it still be valid? And the answer is yes, they can do it, and no, it wouldn't do anything to the validity. And the reason why, because if it were a lien, right, let's say a mortgage or something on community property, you would need the other spouse's consent, but this is not a lien, right? A homestead is not a lien. A homestead is a protection from liens. So either the husband or wife can do it, neither of them needs the other spouse's knowledge or consent. There isn't really any downside to having a homestead. You describe the properties. The Department of Real Estate once asked, do you need a description of the improvements on the property? Like it's a single family home, 2,800 square feet, 4 bedrooms. No, all you need to do is to describe the premises a single family home would probably do. The statement that you're residing on the premises and you want it to be a homestead. A home under construction or unimproved property would not qualify. Why not? Because it isn't your home. Right? You're building it, it's vacant land, you can't do it. Homesteads can be filed on life estates, farms, condos, apartment buildings, as long as you're living in them. But it cannot be filed on an apartment leased for less than 30 years. It's not your home, right? That's just in the homestead law. So termination. A homestead can be terminated in two ways. One, you could actually declare it abandoned. Or two, you could convey the property. So why would you declare an abandonment? Remember, if I'm moving from one area to another, I might, and I can't have two, I would abandon the homestead on the one I have, and then I would declare a new one when I move. And that would be one reason. And if I just convey the title, that by itself will terminate the homestead. If I just leave the property, whether I intend to ever come back or the home burns down by fire, that does not terminate a declared homestead. That's also been a question on the state exam. Now, how much does a homestead protect? I'm not going to go through this block right here because the Department of Real Estate has sort of gone into the word spasm came to my mind, but that's probably not the most accurate word. They haven't been asking about the amount of the homestead exemption. And the reason is because the law recently changed. So if you scroll down a little bit, you'll see that of January 1st, 2021, the whole block that I just skipped over went away. And there was an assembly bill that amended the California Civil Code. And what it did is it made it in some ways less complicated, but there's new numbers. So the countrywide median sale price so the amount of the homestead exemption is the greater of the following. The countywide, median sales price of a single family home in the calendar year prior to the calendar year in which the judgment debtor claims claims the exemption, but not to exceed $600,000 or $300,000. Now, in most parts of California, the median sales price is more than 600,000. So that's typically what it would be. These amounts shall adjust annually for inflation based upon the consumer price index. So the exemption amounts have been raised and will adjust for inflation. And then it goes on, and I gave an example. Now I'm going to scroll back because looking at this block, up until a while ago, the Department of Real Estate was still using the old numbers. Now, that's because, well, they're not very on things, right? If you called the Department of Real Estate, they're not going to answer the phone, at least not for 3 or 4 hours. So they don't have enough people to answer the phone. What that also means is the Department of Real Estate doesn't have this research team, right? This expert team of real estate researchers scanning all the new laws and then going through all of the Department of Real Estate questions in order to make changes. And because that takes time. So what the Department of Real Estate tends to do is when the law changes, first, it takes them a little while to figure it out that the law changed. There are some examples, like for example, when they had the old homestead law, the Department of Real Estate used the wrong numbers for a couple of years before they figured out, oh, the law had changed. The new numbers they didn't even give you as a choice. So all of these numbers don't exist anymore, and they haven't since January 2021. If you're asked a question on the state exam, which they've stopped doing, right? People that have been taking the exam in the last year or two don't get the dollar amount on the homestead question anymore because there's old numbers, there's new numbers, and the new numbers are going to adjust because of inflation. Now, you see, if the Department of Real Estate wrote a question where $600,000, what is the maximum of the homestead exemption that you can get? And it's $600,000. If the Department of Real Estate asked that question, wrote that question, what are they going to do the next year? Because inflation will change the number. It would mean every year the Department of Real Estate would have to revise the number that they're asking, and that's just too much. They're not going to do that. So what the Department of Real Estate does is when they have a subject that's changing and is likely to change again, they just drop that part from their question bank. So my belief is you're not going to be asked a question about how much is the homestead exemption because it was complicated. It's still going to be complicated because of the inflation. But what does this mean, right? What does all this mean? Well, let me give you, should I just do an example? Let's say you have a house and it's worth, let's just say $800,000, right? The Department of Real Estate, by the way, doesn't have any math. Now, before, let's say I have an $800,000 house and I owe $1 million because I had a business that failed. So I'm being sued and they have a judgment against me, and they're trying to sell the house for something called a writ of execution, which is something the lawyers would file that wants to put my property up as on an auction to raise money to pay off the $1 million that I owe. So what the court's going to do is, first of all, they're going to say, all right, the house is worth $800,000, but are there any existing liens? Right. Well, let's say I have 500,000, right, in a existing. Let me just do it like this. So let's say I have a $500,000 loan on the property right now. See, that's a secured lien, and that would have to be paid off before they would give the judgment creditor anything. Right now, how much would my exemption be? Well, if I'm in most of California, the median price is more than 600,000. So that would mean my exemption is 600,000, right? Let me see if I can make sure. 600,000. And that's my exemption. Now, you can see already there's not enough money, right? In addition to that, it's going to cost money to hold the auction, to advertise it and do all that. And how much are the costs of sale? We don't really need to know, because the costs of sale, we've already run out of money. Now, if my property was worth $2 million, you understand now there might be enough equity to pay off a $500,000 loan, give the person who owns the property 600,000 and still be able to pay off the cost of sale. I guess from a practical point of view, if you always keep a high loan on your property, a high percentage loan, so that you don't have $600,000 of equity, they can never take your house to sell it to satisfy a judgment. They have to sell the property, pay off all of your loans, any taxes, any loans, first, second, third, doesn't matter, all the loans, give you 600,000, which is going to go up, cover the costs of sale, and have something left over. If there's nothing left over, then they don't sell the property. Now, they're not going to give you a math question on the state exam, but that's the idea. That's with this priority of payments. You're very unlikely to be asked a question about the numbers, but they almost always have questions about homesteads on the state exam. In fact, a better way to say it is homesteads are mentioned in Department of Real Estate questions often on the state exam. And let's say everything that I have said so far was one of those, wah, 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 and you're like, I don't understand, I don't get it, I don't know what he's talking about, I don't really know what a homestead is. There is one thing you can remember. One thing you can remember. And if you remember this one thing, it will resolve about 90% of the time, at least, when a homestead is mentioned in a question on the state exam. And that one thing is, a homestead is not a lien. I have a workshop for people to go take the state exam, and sometimes, frankly, I'm amazed, because there are questions we go over that talk about homesteads, and sometimes, like, almost everyone in the group gets the question wrong because they think a homestead is somehow some form of a lien. A homestead is not a lien. A homestead is no more of a lien than an umbrella is rain. You wouldn't say, well, an umbrella and rain, they're the same thing, aren't they? No, umbrellas protect you from rain, but an umbrella is not rain. Homesteads are not liens. Homesteads protect you from liens, but they are not a lien. And there's a homestead filing service. By the way, if you get, many people do, you buy a house. I've had clients recently, I bought a house and I got a letter, and the letter says if I send them a certain amount of money, it's usually 25 to 50 bucks. I forget, there's a limit. But if I send them 25 or $50, they're going to homestead my property for me. Should I do it? The answer is no, your property's homesteaded already. And by the way, you don't have to, let's say for some reason your property wasn't homesteaded. Oh my gosh, and you're being sued. Is it all over? The answer is no, still not all over, right? So let's say you're living in a house and for some reason it's not homesteaded and you're being sued. and you show up to court for the last day, and your lawyer says, be sure to wear your running shoes just in case, right? And you're sitting there next to your attorney, and the judge is saying, you owe them $1 million, and slams the gavel down, and your attorney pops open their attaché case and takes out a declaration of homestead and hands it to you and says, go. And you jump up from your desk and you run out of the courtroom. The plaintiff, the people that are suing you, run up to the clerk, grab a copy of the judgment, and they run after you. And you're driving fast down the street, cutting off people, trying to not let the person behind you get around you. You come screeching up in front of the county recorder's office, running in with your declaration of homestead, and you put it down on the counter, and they slowly, come up, and they take your form and stamp the form, and then the guy comes running in with the judgment. Too late. Too late. What I'm saying is, you don't have to record the homestead before you're sued. You don't have to record the homestead before you lose. You just have to record it before the judgment is recorded against you. That's all. You understand? It's like an umbrella. You don't have to walk around with it open all the time. You can wait for it to rain. Anyhow, then those are the new numbers, just in case anybody asks you about them. Occasionally clients do. I put them in. I put in a bit of an explanation. The current homestead exemption is automatic. You don't have to file a declaration, but if you do, your equity isn't lost after the homestead. Right now, I forgot about this. The new rule is, even if you lose, you still are given a period of time to file a homestead. It just occurred to me that now, if you lose a judgment, they automatically give you a form to declare a homestead if you don't already have one. Right? So don't worry about it. Don't pay anybody, or send me the 50 bucks. I don't know. Let's talk about something else. This is going to be on your test, and it's called a promissory note. And I have an example of a promissory note. Right? They don't have to be complicated. I, Jane Monroe, do promise to pay city finance the sum of $50,000, repayment to be made in the form of 300 payments, 6% interest, $322.15, payable in the first of each month beginning until the debt is satisfied, signed, dated. That's it, right? That's all you really need in a note. A note is an IOU. That's all it is. Legally, technically, it's evidence of the debt. It's an IOU. Now, there are two types of notes. There are what are called straight notes or term notes, and then there are amortized notes. And amortized can either be partially amortized or fully amortized. And fully amortized could be plus interest or could be including interest. We're going to go through all that. So what we mean by a straight note, have you ever heard of a loan that's billed as a interest-only loan? Doesn't that sound like a great loan? All I have to do is pay interest, right? That must be a lower payment. So if you had a loan and all you paid on the loan was interest, when would you stop making payments? And the answer is never, right? Because the loan isn't satisfied until you pay off the principal that you borrowed. So a straight loan would be, I borrow $50,000, I make payments of interest only for 5 years, let's say, and at the end of 5 years, I owe $50,000. You've heard of a balloon payment, right? You've heard of a balloon payment. This is the Goodyear blimp, the Zeppelin of the balloon payments. This is a huge balloon. The balloon is at the end of the loan, and it's everything you borrowed. Amortize comes from the Latin word mort, because I think that was the name of the guy who originally thought of it. I think his name was Mortigue. That may be wrong. Don't write that down. Mort is a Latin word that means dead. So like mortician or morgue. So amortized means the death of the debt. What is amortized? on a loan? What is amortized on a loan? Principal, interest, or both? What's amortized? And the answer is just the principal. Paying interest does not kill the debt. Killing the debt means paying principal. Only the principal is amortized. Now, it could be partially amortized. We're actually starting to see again as interest rates go up, in the new old loans are coming back, but there's a loan called a 30 due in 10. And there's a 30 due in 7, there used to be, but let's just stick with the 30 due in 10. What a 30 due in 10 is that you get a loan to buy a house, 30 years, it's amortized like you are going to be making the payments for 30 years. But at 10 years, you pay all of the remaining balance of the principal at one time. 30 years is how they stretch it, but in 10 years, you have to pay off the loan. Why would people do this? Well, they have lower interest rates. Also, what people are thinking is, heck, in 10 years, my property is going to have appreciated and I could get a better loan and maybe interest rates will go down and I'll pay off the loan. That's a partially amortized. Partially amortized means there's a balloon payment. Fully amortized is a 30-year fixed rate loan, right? Or a 30-year adjustable rate loan. Those are fully amortized loans. So the promissory note is the evidence of the debt. I think I mentioned that. It is the evidence of the debt. I can do it. Evidence of the debt. It is secured by a mortgage or trust deed. So the note is not a lien. The note is not an encumbrance. The note is simply an IOU, evidence that you owe the money. Mortgages and trust deeds are the lien. They secure the note, which means if you don't pay the note, they can take your house. And we're now entering a fun subject. We're going to spend some time tonight talking about what is a negotiable instrument. Now, it says here, personal property, right? That's a question on the state exam. Is a negotiable instrument real property? Is a negotiable instrument, which could be a note on a home, is that real property or personal property? And the answer is it's personal property. It cannot be recorded, the note. Why not? Because you can only record documents. There's one exception involving business opportunities, which I'm not going to get into right now, but as a general rule, you can only record documents that affect either the title to or possession of real property. A note does not affect the title to or the possession of real property. It is simply evidence that you owe money. The mortgage, the trust deed, you can record those because they affect title to and possession of the property, but not the note. So I worded it a little bit differently, but you have the straight note. Amortized, right, is either partially or fully, and you can have a plus or an including interest. I'll get to that. So straight note also is referred to as a term note. All of the principal is paid at maturity, and maturity means not when you reach a certain age, but when the loan term is up. Interest is oftentimes paid during the term of the note. And the final payment would be the entire principal plus 1 month's interest. I thought about deleting this, but I don't know. The reason that appears in the outline is the Department of Real Estate had a question. And the reason I was thinking about, maybe not even including it, because the answer involves arithmetic to a little bit. And starting some years ago, the Department of Real Estate pretty much got rid of all the math on the state exam. But this is what the question said. These aren't the exact numbers, but they're close. A person has a loan for $50,000, 7% interest, 5 years. The number of years is not relevant to the answer. The question the Department of Real Estate asked was, how much would the final payment be? That was the question. Now, first of all, we know that the final payment on a straight loan is the amount that you borrowed, $50,000. That was a choice, not the right answer. In addition to the $50,000, there would be 1 month's interest. Why? Because interest is paid in arrears. Let's say it's April 1st and you're making your mortgage payment. You're paying for March's use of the money. If interest is renting somebody's money, if you rent an apartment, they want the rent at the beginning of the month. But if you rent money, they want the rent at the end of the month. So on April 1st, let's say at the end of March, my straight loan for $50,000 is over. So on April 1st, I got to pay him 50 grand, but I also have to pay 1 month's worth of interest. So what the Department of Real Estate wanted you to do is take 50,000, multiply it times 7%. I think that's what they had in the question. Divide by 12, add that to 50,000. But the Department of Real Estate doesn't ask math. The final payment would be for the entire principal plus 1 month's interest. That's it. Plus interest. Questions on the state exam. It's an installment note calling for periodic payments of the principal. Payments being separate from the interest payments. Principal plus interest. Also sometimes referred to as the straight principal reduction plan. So let's say I have a loan and it's $1,000 a month plus 7% interest. Let's say my loan is $50,000, 7% interest. So what I would do is I would take 50,000 times 7% and divide by 12. That would give me the first month's interest. I pay $1,000 towards principal and 7% of 50 divided by 12, that's the interest. Month number 2, I no longer owe $50,000. I paid $1,000 of it off. So I still pay $1,000 for the principal, but then I take 49,000 times 7% interest, divide by 12. That's the second month's interest, which would be a little less than the first. You see what I mean? Each month, the amount of interest you owe goes down, and that is added to the principal. Now, let me just, I've also taught this course for real estate brokers, and I don't like to. The reason I don't like teaching people to get a real estate broker's license is not because I don't want them to become a broker, it's just that they're so hard to deal with. And usually when I'm teaching to salespeople who want to be brokers, particularly those that have been around a while, they're howling when I'm doing this part, which you just heard. Why are they? This is what they say. They raise their hand, they say, wait a second, I've been a real estate agent for 20 years and I have never, ever heard of a loan like this. Has anybody ever heard of a loan like this? Everyone goes, no, I've never, but there is no loan like this. Right now, and they're kind of right. Have you ever had a loan where the payment amount changed every month? I mean, I guess they're possible, but I haven't ever seen one either. So then they would be saying to me, well, why are you explaining something that doesn't really exist? And the answer is because it's in textbooks and on the state exam. Where does the Department of Real Estate get their questions from? Are they talking to lenders about what are the typical loans and how they work? So they're asking practical questions about loans that you're going to see as a real estate agent? And the answer is no, that's not what the Department of Real Estate is doing. What they're doing is they go through textbooks, sometimes old ones, and government publications, and they find something and they say, oh, this would be interesting, wouldn't it? And they write questions about it. Right? But yeah, you're never going to see one, not in real life. What kinds of loans do we have in real life? And they're all, as a real estate agent, they're almost all including interest loans. So periodic payments, fixed, include interest and principal. The portion that is applied to principal increases. but not by a constant amount. That was the question on the exam. Payments of principal and interest until it becomes zero. You'll be amazed to know that I personally drew the first diagram without anybody's help. So let's say our loan was $1,000 a month, including 7% interest. See, that's a big difference in saying $1,000 a month plus 7% interest. So we would take the $50,000 times 7% divided by 12. So we pay $1,000 minus whatever that number is, and whatever is left over. And by the way, at the beginning, very little is left over. But whatever is left over goes to the payment of principal. So the first month, you pay $1,000. You subtract what 7% of 50,000 divided by 12 is. And that little bit left over goes to principal, month number 2. You no longer owe $50,000. No, you've made a payment towards principal. You only owe $49,900 or something like that. So they take that number times 7% divided by 12, and it's just a little bit less interest than you paid the first month. Not a lot less, but just a little bit, which allows a little bit more principal. Right now you paid off $150, $200 worth of principal. You understand this takes a long time before it starts to pick up steam, right? Where pretty soon the amount that is going to principal shoots up and the amount that goes to interest is going to go down because the interest is based upon the remaining principal. This is why lenders love it when you refinance. Well, I'm lowering my interest rate. Yeah. But you see, if you refinance like every 5 years, now it's true, your payment may go down. But what you're refinancing, you haven't paid off hardly any principal. So I know people that have loans for 5 years, 3 years, and they went to refinance it. They said, wow, I've been paying like, $4,000 a month. And they tell me I've only reduced my principal by a couple of grand over 4 years. It doesn't make any sense. Well, that's because almost all of your payments have gone to interest. That's just, I don't know why. There it is. Partially amortized is a balloon payment. Same. If payments do not cover the interest due, negative amortization is the result. So if we're paying $1,000 a month, including interest, but the amount of interest is more than $1,000 a month, what do they do then? Well, they add it to the principal. Now we're going to see later that there's graduated payments where it goes up over time. I'll get to that. So if amortization means the death of the debt, negative amortization means you're not killing the debt. You're feeding it a high carb breakfast and taking it to the gym every day, right? It just gets bigger and bigger and bigger. There's going to be usually graduated payments. I'll explain that. The word amortization is the liquidation of a debt by installment payments. Amortization tables, there used to be a time when real estate agents used to carry around little books, right? Before cell phones, I guess, little books, and they would have literally tables that would show you for every $100,000 at what interest rate, what the payment would be. Now, there's an app for that. Graduated payments. The thing about negative amortization is it seems like you're just getting in more debt every time, right? Every time you make a payment, you owe more money than you did before. It's compound interest because the interest that you didn't pay is added to the principal, which means you're paying interest on what was interest. That sounds terrible. So usually negative amortized loans have a graduated payment. Lower payments in the beginning, payments increase, then level off. Why do we have these? Well, we haven't in a while. There hasn't been a lot of them, but if interest rates go up a lot, they might make a comeback. This is the logic. A power couple has decided they want to buy a house. They're working for big tech companies. The future is bright. They can either buy a house that they can afford today, or they could buy a house that they believe they will be able to afford in the near future. Which one do you think most people, some people might want to go for? Some people want to go for the second option. I would like to buy the house today that I know I'm going to be able to afford in a few years. How do you do that? Well, you start with a loan where the payments, because qualifying for a loan is based upon the amount of the payments relative to your income. So you start with a loan where your payment doesn't even cover all your interest. But as you do better financially and your income goes up, you finally reach a point in time where you can afford the payment based upon the what it would normally be, right, with the higher payment because your income has gone up. You just need your income to go up. Adjustable rate mortgages, a ARM, also known as a variable rate mortgage. We haven't seen these in a while, but lenders today are talking about them again. And the reason is because adjustable rate mortgages often have a much lower interest rate than a fixed rate loan. See, if the loan is fixed for 30 years, then the lender is locked in for 30 years at that interest rate. But if the interest rate can adjust and go up with the market, then they're willing to, it's not much of a risk. It's a lot less risk, so they'll start you at a lower rate. Now, there are two parts of an adjustable. There what's called the index and the margin. And so what the index is what is money worth? How do we know what money is worth? Well, one way is to see what is the wholesale value of money. Now, what I mean by the wholesale value of money is what do lenders charge each other for money, right? And that's wholesale value. So an index would be something like, it's called a cost of funds index. There was LIBOR. LIBOR stood for the London Interbank Offered Rate. There's the 7th District Cost of Funds, right? There's a bunch of them. And sometimes some are more volatile than the other. So the index, if the index goes up, which means that the cost of funds goes up, your interest rate goes up. Now, the margin is the profit that the lender wants. That doesn't go up or change. That's usually just a fixed amount. By the way, that could be determined by your credit score. It could be determined by the amount of the loan. It could be actually affected by geography. So that can tend to vary. The margin, which is the profit that the lender wants to make, is fixed, and the index is what adjusts. They usually include interest and or payment caps. So what that means is they'll say, hey, you don't have to worry. It's not going to go up a lot. It can only go up X amount, right? Any one year, it can only go up so much over the life of the loan. We guarantee your payment won't go up by a certain amount. Other types, there's the RAM, the reverse annuity mortgage. If you watch television a lot and you see a lot of ads for this, it means you're old, probably, or at least what you're watching is designed for an older demographic. See, typically, when you get a loan, you make payments to the lender. Isn't that the idea? In a reverse annuity mortgage, it's the other way around. You don't make payments to the lender makes payments to you. Right? So this is for people that are old and they don't have an income, but they got a lot of equity. They don't want to sell their house, but they have a lot of equity. So they take out a reverse mortgage. They get sent money every month. When they die or upon the end of the term, they sell the property, it pays off the loan. Shared appreciation mortgages is when a lender receives a share of the future increase in value. Have I ever seen one of these in residential real estate and all the, time no, never saw one. But it's in textbooks and therefore it's on the state exam, but not a lot of questions. Interest. Interest is price or rate of premium per unit of time. Price or rate of premium per unit of time. I have a simpler way of saying that. Rent. Rent. Rent is a price or rate of premium per unit of time, like monthly rent, annual rent. So renting money, you pay interest. 9% is called the legal rate or the imputed rate, which is the rate set by law. They haven't been asking the 9% in a while, but anyhow, that's what it is. Usury is when you take more than the maximum amount allowed by law. Some loans, and by the way, loans arranged by real estate brokers are exempt. A whole lot of loans are exempt from usury laws. And so there was a question on the state exam and said, which of the following would make it be illegal? And one of the examples is somebody was borrowing the money at 12% and then lending it at 14%. 9%, excuse me, 10%, I think, is the maximum rate. Anyhow, that would be an example of usury. Other words that appear on the state exam: nominal is what is named. Effective is what is actually paid. Simple interest, remember $50,000 times 7% divided by 12. Then we deduct, again, 49,000 times 7% divided by 12. That's simple interest. Compound interest is like a negative amortized loan. Interest is charged on the loan balance plus accrued interest that has been added to the principal. That would be negative amortization. Let's take a look at what we mean by nominal and effective. So let's say I've lent somebody $1,000 and it's all due and payable in 1 year, 8% interest. That's $80. But I need some money now. So I find somebody who would like to buy my loan. I sell it to them for $800. Now, the nominal rate, and nominal does not mean smallest. There are questions on the state exam. What does nominal mean? Nominal does not mean small. It means named. If you were nominated for something, you've been named for it. So what is the rate named in the note? And the answer is that's 8%. But if I sell the loan for $800, $80 might be 8% of 1,000, but $80 is 10% of 800. So 10% would be the effective rate, right? 8% would be the rate named in the note. Interest. Interest on a loan from a bank is oftentimes figured on what's called a banker's year, which is 360 days, or a banker's month, which is 30 days. You know, there used to be the old line about working banker's hours, right? Because banks tended to open late and close early. Not only did bankers have their own hours, apparently they had their own months and years, and they were all a little bit shorter than ours. The formula for interest would be the principal times the rate times the time. And on renegotiable rate mortgages, you can't fluctuate the rate by more than 5%. Interest is usually paid in arrears. That means at the first of the month, when you make a payment, you're paying for the previous month's interest. GPAM. I remember when the Department of Real Estate started asking about this. This is also not a loan that is commonly known by people that, know real estate. Some people thought, isn't that like some sort of a canned meat dish? I don't know. I don't know. Maybe that's wrong. It's a graduated payment adjustable mortgage. What do they want you to know on the state exam? It defers payment of principal. So it's a graduated payment loan, which we've already talked about. There would be negative amortization. But after the first 5 years, the loan payments go up a lot. Negotiable instrument. First of all, what do we mean by the word Instrument. An instrument is a piece of paper that has some legal effect. Mortgages and trust deeds and notes are instruments. What does negotiable mean? It's a weird word used in this context, but negotiable means that you can negotiate it with somebody else. All right. Let's take a look at a check. All right. So let's say, that's really not what I wanted to do. Let's say that somebody writes me a check for $500, but I owe somebody else $500. If I take that check to me and I turn it over and I write pay to the order of, write in the other person's name and sign my name, I've negotiated the check. I've transferred it to somebody else. So a negotiable instrument or a negotiable note is a note that can be turned over to somebody else, signed over to somebody else. Trust deeds or mortgages are not negotiable. In other words, how did I get to red? I don't know how I got to red, but they're not negotiable. And the reason a trust deed or a mortgage is not negotiable is that you can't just, I guess I'm going to do red until I think about this. You can't just take a trust deed or a mortgage and sign your name on the back and give it to somebody. You can't do that, right? Because they're more complicated. Mortgages are contracts, and contracts have to be assigned. A deed, yeah, the deed, you can't just sign your name and give it to somebody. You need a new deed. So they're not negotiable instruments. Only in our discussion, we're talking only the note is negotiable. And another way to put it is the negotiable instruments are freely transferable in commerce. I guess I'm doing red tonight. Huh? This is going to be fun, right? A holder in due course. Innocent third party, taken a negotiable instrument before it was overdue, good faith, for value, without knowledge of any defect. A maker cannot refuse to pay a holder in due course if there is a lack or failure of consideration of the original payee as an individual. I have no idea what that means. I've summarized the first two bullet points with innocent third party, and a maker cannot refuse to pay a holder in due course. Let's look at an example. All right. I have a car for sale. Put an ad in Craigslist. Picture of the car. Looks okay. You call me up and you say, hey, I see you have a car for sale and I see, the picture and it looks like a reasonable car. I noticed there wasn't a price. Can you tell me how much is the car? And I say, well, the car isn't in all that great a shape. $1,500. $1,500 and you can buy the car. And you're like, oh, that sounds like a pretty good deal. The car looks really nice, but I just don't have $1,500. And I'm like, well, how much money do you got? And you say, well, I only have like $500. And I'm like, I like the sound of your voice. I'm very intuitive about this sort of thing. I can tell that you're an honest person. So I'll tell you what I'll do. You give me the $500. You can sign a note for the other 1,000. I give you the keys and you got a car. You're like, cool. So you send me the $500 and you sign a note for $1,000 payable to me. In this, you're called the payor. You're also called the maker. I am the payee. They don't call me the makey because it just doesn't sound right, right? There's a maker, but no makey, but there's a payor and a payee. Now, in a check, there's a payor and a payee. One of them signs and the other one endorses. Is there a difference between signing a check versus endorsing a check? Is there a difference? The answer is yes. The person who signs the check signs on the front. The person who endorses the check signs on the back. It is better to endorse than it is to sign. So you signed the note for $1,000 to me. I endorse the note. Now, let's say that I tell you where the car is and I give you the keys. You go to pick up the car. You notice as you walk around the car that the back side of the car doesn't look like the left side of the car looks better than the right side of the car. And when you walk around, you can see that the only reason the car is the tires don't look like they're flat is because there's wooden blocks holding up the car. You sit in and you turn the key and nothing happens, and you open up the hood. There's no engine in this car. Now, I'll bet at this moment you're not happy with the deal I made with you. Do you want to keep making payments to me or to start making payments to me on the $1,000 note? Probably not. You want your $500 back. So you could tell me and say, I want my money back. I'm not going to make any payments. If I tried to sue you to collect on the $1,000 note, you got a defense. And your defense is, he lied to me about the car. And I wouldn't be able to collect. So if the payee tries to enforce it, it's not going to work because I defrauded you. But let's say I sold the note to a holder in due course. And the holder in due course buys the note behind, let's call it a curtain of innocence. So that means the person who bought the note didn't know didn't know about the car. They didn't understand any of the things I did. They paid good money for it, so it looked like it was in good faith. Although you have a defense against me because I defrauded you, you don't have a defense against the holder in due course. A maker cannot refuse to pay the holder in due course. In reality, we're not talking about checks. We're not talking about, beater cars being sold. What we're talking about are loans being marketed on the secondary mortgage market. So let's say a loan agent in California makes a loan with Bank of America. And then Bank of America sells that loan to an investor bank east. And then later, the borrower on the loan alleges that the loan agent and Bank of America lied to the borrower, defrauded the borrower in order to get the borrower to enter into the loan agreement. Now, if that's true, it might work against the Bank of America. But if the loan has been sold back east, excuse me, it's not going to work because the investors bank east that are buying the notes are all holders in due course. And you see, they have this rule because the investors that are buying the notes would be reluctant to buy the notes if there was some issue involving the loan agent that later could make the note not worth anything. So the rule is, if it's sold on the secondary market and they bought it in good faith and paid reasonable value, they're holders in due course. And although you might have an argument not to pay the original lender, you still got to pay the holder in due course. Now, talking about endorsements, blank means you sign your name. Special is when you write pay to the order of, put in somebody else's name, then sign your names. Deposit only is restrictive. Right? These are for people that haven't figured out mobile deposits, I guess, but you can write that down. Why don't you write that on the back of the check just in case you drop it, somebody can't cash it, they have to deposit it. Signs the name. But the one that's really fun is qualified. And qualified means without recourse. And then signs the name. Then signs the name. This means that if maker refuses to pay, endorser will not be personally liable. Holder of the note would sue the maker or foreclose for the unpaid balance. Let's say I owe your money. And every time you see me, you say, hey, Mike, where's my $500? And I always say, oh, I'm really sorry. You know, I had it just a day or two ago and I was looking for you, but I didn't find you. And now I had to pay somebody else. I don't have the money. I'll get you next time. And the next time, you hear pretty much the same story. Finally, you'd corner me one day and you're like, where's my $500? And I say, like, sorry, I've been, putting you off, but today's your lucky day because I'm going to be able to get rid of this debt for both of us. We'll both sleep better at night. See, my friend George has owed me $600 for a really long time. And finally, George has paid me. And I show you, there's a check from George to me, $600. And just because this has been such a hassle and I feel so bad, how about this? I will give you George's $600 check. So not only are you going to get your $500 back, you're going to make an extra $100. Isn't that great? Isn't that great? And you're like, okay, that sounds fair. Let's do it. So I take, George has written me a note. I flip it over. I write, pay to the order of, and I write in your name. I sign my name, but being sneaky, because I've gone through real estate school, being sneaky, I write after I sign my name without recourse. Give you the note. The check bounces. You come to me and you say, hey, the check bounced. I want my money. And I'm like, hey, this isn't my problem, right? You took my $600 check in lieu of me paying you $500. And you did it without recourse. So in this example, right, George is the maker or the payer of the note. I am the payee of the note. You are the holder of the note. You try to sue me because the check bounced, and in the way you see it, I still owe you $500. I have a defense. And that defense is without recourse. Because what I did is I passed on that note in lieu of my debt. I didn't add my personal guarantee to it. So you're not going to be able to collect from me. You would need to go to George. George says, all right, yeah, sorry about that. The check bounced, yeah. But Mike told me that he only owed you $500. So I don't think I need to give you a six because this was for a $500 debt. No, that's not going to fly because George wrote a check for $600. You can make George pay you the $600. On the state exam, and we have the sample question. On the state exam, the Department of Real Estate has a question about this. Right, not every state exam has this question, but I'm just saying it's a question that's been on the test and it's in our testing bank, where the issue became, does the holder get the amount that was owed to the holder, or does the holder get the full amount of the note? And the answer is the full amount of the note. Discounting a note, selling a note at a discount means selling it for less than the face amount. Joint and several. Joint means together, several means alone. Now you might think, doesn't several mean together? Like there's several of us? It's not several, it's severed. So if you have severed yourself off from everyone else, you're all alone. So joint and several, that means there's more than one person signing the note, would commit all of them or any one of them for repayment. The answer to the most common question about joint and several is it would commit all the borrowers the most. A promotional note. It's secured by a trustee on, this is just a definition that's been on the test, unimproved property after construction of an improvement, but before the first sale of the property, not for more than 3 months. Now, subdividers. So let's say I'm a subdivider and I'm selling a house for $500,000. So you get I've already lined up financing 80% first loan from a lender, and that 80% loan would be $400,000, which means in order to buy the subdivision house, you would need $100,000. But in order to sweeten the deal, I tell you as the subdivider, as the seller, that I'm going to make this an 80-10-10. And what an 80-10-10 is, you get an 80% loan from the bank. I, as the subdivider, am going to give you a 10% second. That means you only need 10% down. That's $50,000 from you. I've made a second for $50,000. Now that loan that I made, the $50,000 second, that's a promotional note. Usually they're short term. You have to pay them off in the first couple of years, right? It's just made to get you into the property at a lower down payment. That's called a promotional note. How about that? That's how I do. All right. Loan document clauses. I wasn't seeing the little palette there. There's an acceleration clause. You're going to see the word acceleration on the state exam. To accelerate means you owe all sums. It's called calling. To call all sums owed immediately due and payable. So when the lender calls the loan, it's called accelerating the loan. Accelerating the loan is calling the loan. It's just a thing. And it means you owe all the money all at once. It's also a default clause. It does not affect the negotiability of the note. There's a question on the state exam that said, if a note has an acceleration clause, is that going to make it less likely for investors to buy it? And the answer is no, it'll make them more likely to buy it. And by the way, default does not necessarily mean you didn't make a mortgage payment. Failure to pay property taxes is a default on your loan. Failure to have homeowners insurance is a default on the loan. Running a meth lab in the house is a default on the loan, right? All of those are defaults. There's one thing that is so common in terms of being a loan clause, one type of acceleration clause that is so common, it's got its own name, and that's an alienation clause. And the word alien means strange. So an alienation clause is when a stranger is in the property. In the business, we would refer to it as a due on sale clause. And what a due on sale clause means that all sums, they could call all sums immediately due and payable if title is transferred. That means buyer cannot assume the loan. It is a type of acceleration clause. And there is a question on the state exam that says, when would a lender not enforce a due on sale clause? And they would not enforce a due on sale clause when deflation occurs and there are more houses for sale than there are buyers. Now, you can't use what's been going on in real estate in California really for the last 3, 4, 5 years because it doesn't really match textbooks and things like that. But why do lenders care? Right? It's a question, whether or not your loan is assumed or not. And the answer is they're greedy. So if interest rates are going up, and let's say you got a loan, 30-year fixed rate loan at 3 something, right? It's 3.25%. You got a good rate when the market was really low for loans, for interest rates. And now interest rates are at 6, 7. But you've got a relatively large loan on your home for 3 something. If the buyer who buys your home could assume your existing 3% loan, that would be really cool, right, for the buyer, and they might even pay more money because of that. But the lender's not going to let you do that, because what the lender wants you to do is pay off your 3% loan so that they can lend the money at 7% to the borrower. So if interest rates are going up, lenders enforce due on sale clauses. That's one point. A related point is that interest rates are tied to inflation. That's true. As inflation goes up, interest rates go up. But let's say the cycle is going the other direction. deflation is occurring. So inflation is going down, interest rates are going down. If interest rates are going down, lenders don't care about due on sale clauses because now your loan is 7%, but the market now is down to 6.5%. Lenders will allow borrowers to assume your loan. Of course, there's a question, why would they? Couldn't they, just go get a new loan at a lower interest rate, which is a very practical question. But in the textbooks and on the real estate exam, they don't really get into practical questions. So if deflation is occurring, then lenders don't care about due on sale clauses because it means interest rates are dropping. And they don't care. If interest rates are rising because inflation is rising, then they enforce this loan. A subordination clause. To subordinate means to put underneath, which means the lender with first priority agrees to take a subordinate position. It oftentimes would be in a junior lien that permits the first lien to be refinanced. It is also used when developing land, and it is the opposite of superior. Let's start with the junior lien. I have a house, I have a first loan, I have a second loan. Interest rates have gone down. I would like to refinance my first. Now, the point here is that a refinance is not a tweaking of the first. It's a replacement of the first with a new loan. So whether or not a loan is a first loan or a second loan is not decided by the size of the loan, but is decided by when the loan was recorded. So if I have a first and a second and I refinance the first, what would happen is the second would move into first position and the refinance would be the second loan. Big loans do not want to be in second position. They want to be in first. So you won't be able to refinance unless the second has a subordination clause that says it's willing to give up priority to a refinancing of the first. When is it used in developing property? Let's say I'm going to be a spec builder. And a spec builder is somebody who drives around, they see a vacant lot, they buy the land. Loan number one, buy the land. Loan number two, now that we own the land, we got to build on the land. That's a construction loan. Well, construction loans are generally a lot bigger than the loan to buy the land because the land isn't worth that much until you build something. So the loan to buy the land came first, so it's in first priority. The construction loan, the bigger loan, would be a second. Big loans don't want to be second, they want to be first. So the loan to buy the land would have a subordination clause that says it will give up its first placement, first priority to a loan to build, a construction loan. Why would a lender do this? I've been asked. Why would a lender do this? And the answer is because if they don't, you'll never get a construction loan. And if you never get a construction loan, you'll never be able to build on the land. And if you can never build on the land, you're never going to sell it. And if you never sell it, you're never going to pay off the land loan. Lock-in. Lock-in means you cannot pay off the loans in advance. Not allowed owner-occupied property, 4 units or less. Not in California. So a lock-in would say your payment is $4,000 a month, period. You can't pay more. But if it said your payment is $4,000 or more, now that's actually a clause. It's just a really short one. Or more, it means the borrower can pay an additional amount without penalty. You could pay more. Now, sometimes there's a prepayment penalty. It's an interesting concept. If I borrow somebody's money, I pay interest to rent their money. What is a prepayment penalty? It's when they're charging me for not using their money. Interest is when I'm using their money. Prepayment penalties is when I'm not using the money. So what the lender is saying, hey, you paid the loan off too soon. We were counting on you to keep making payments for a lot longer, right? We were hoping for the money. So a prepayment penalty is prepaid interest if you pay off your loan too soon. Lender may waive if they can make a new loan at a higher interest rate. Oh yeah, even loans with prepayment penalties, when interest rates go up, you'll get letters saying, hey, you want to pay off your loan early? It's okay with us. We'll waive the prepayment penalty because they can charge more. Common on the exam, more common, is the question, when can you not have a prepayment penalty? And it's not allowed residential property, 4 units or less, after the loan is 5 years old. So what that means is they can only charge you a prepayment penalty during the first 5 years. After 5 years, you can pay off the loan. Now, this hasn't all been, the details are not always on this, hasn't ever been on the state exam, but California law says that you can prepay talking about a home loan, 1 to 4 units, owner occupied property. You're allowed in California to pay 20% of the original loan balance in any 1 year without a penalty. If you pay more than 20%, the penalty is at a maximum 6 months interest. That's what the maximum is under California law. So I could pay 20% the first year, no penalty, 20% the second year, no penalty, 20%. You see, and in 5 years, I could have paid the whole thing off, no prepayment penalty. On year 6, and there's a question on the state exam about what happens in 6 years, you can pay the whole thing off, no prepayment penalty, only during the first 5 years. An open-end loan means you can keep going back to the well and pulling out more money. It means that you can borrow additional money without rewriting the loan documents. It's kind of like a HELOC in the sense where you have a line of credit and you can get more money and you don't have to rewrite it every time. An assignment of rents clause is oftentimes found in income producing properties when the borrower defaults, and it says the lender gets to collect the rent. This is common in commercial leases, right? If the owner of the property is leasing it out and the owner isn't making payments on their loan and the lender is foreclosing, there is a default, it kicks in and it says that the tenants now have to pay the lender directly. It benefits the beneficiary, which if you don't know yet, you need to know for the state exam, is the lender. So just the word. Lending practices. There's a mortgage evaluation. And what the lender is looking at is what is the degree of risk. First thing they look at is your income. And they use something called a debt income ratio, which is a loan qualifying tool. The percentage varies from lender to lender. So some used to be 40%, some are 43, some are 45. I have a transaction going on right now where it's closer to 50. What's that mean? Let's say I'm making $10,000 a month and the lender is using a 40% debt to income ratio. What that means is 40% of my income can go towards my long-term debt. So if I'm making $10,000 a month and the lender is using a 40% ratio, it means my maximum loan payment will be $4,000, 40%. So how do lenders determine how much money you can afford? Is they look at how much money you make and then they apply the ratio. And then that sets a maximum loan payment. Now, if you have other long-term debt, that gets deducted. So the maximum of your long-term debt is what the ratio is looking at. And it varies. It varies on your credit rating. It varies on a lot of things. It varies on your down payment. It varies on a lot of things. But it's usually right now someplace in the 40 to almost 50%. So they're going to look when they're evaluating how much money you make. They're also going to look at the borrower's character, which really means your FICO score. It means your credit rating. This is the hardest to evaluate. Just because I paid my bills doesn't mean I'm going to pay my bills. And in fact, when the market crashed in 2008 and 2009 and things were going down, what people were doing is they would buy another property while their credit was still good. Then they would just not make payments on one of the properties they already owned because it was upside down. They owed more money than it was worth. That, of course, hurt their credit rating. Too late, they'd already bought another property. What does FICO stand for? And by the way, as a real estate agent, that's the kind of question when you meet somebody, they're going to ask you, right? Because, hey, I've already heard about FICO score. What's FICO stand for? Financing, interest, credit, what does it stand for? And the answer is FICO stands for Fair Isaac Corporation. There were two guys. One's name was Fair, and the other one's name was Isaac, last names. They were the ones who got all of this started. And they devised a way of taking the information from the credit bureaus and coming up with an overall score. They haven't asked on the state exam what FICO stands for, but I knew you'd want to know. Does bankruptcy affect your FICO score? Yeah. So occasionally the Department of Real Estate is asked bankruptcy questions, like what is covered and what isn't covered. Well, you can't use bankruptcy to get out of alimony, child support, or owing taxes. And only the debts that exist when you file bankruptcy are discharged, not things you get later. The Department of Real Estate asked a question that says, if a lender has made you a loan and then you've declared bankruptcy, can the lender make you another loan? Is that legal? The answer is sure, why not? In fact, this is odd, but sometimes after a couple of years, the lender whose loan got removed in the bankruptcy will actually write you a letter and says, hey, it's been a long time. Do you want another loan? No, although that might seem weird because you went bankrupt on them and, but they already know that you got rid of a lot of your debts and they want another shot at you. If an owner files bankruptcy during a listing, all the decisions are made by the bankruptcy trustee. And if you try to get rid of the property before the bankruptcy hearing so they won't know about it, yeah, that's a federal crime. So in order to determine whether or not somebody's going to get a loan, number one, they look at your income compared to your debts, including the new one. Number two, they're going to look at your credit rating. And number three, they're going to appraise the property. And that would determine the loan to value ratio. An example, let's say I have a 80% loan to value ratio. I'm buying $1 million house, and an 80% loan to value ratio would mean an $800,000 loan, right? But the property doesn't appraise for $800,000. It only appraises for $750,000. Am I still getting, I did that wrong. It's $1 million house, 80% is $800,000. I knew there was an $800,000, but the property doesn't appraise for $1 million. It only appraises for $950,000. I'm not still getting an $800,000 loan because the 80% is 80% of the appraisal. It is not 80% of the purchase price. This is a common question on the state exam. Loan to value ratio is not loan to sales value, but loan to appraised value. Lowest loan to value ratio is on land. This general aspects is a list of things that have been on the state exam, just sort of a dump of them. Stability of the money market is unimportant if it's a long-term loan because it's a long-term loan. You would refinance to lower your payments. This is an interesting statement. Answers a question on the state exam. A cost of home ownership is the loss of interest on the owner's equity. It's an economic thing. If you've ever read Robert Kiyosaki, right, who wrote a book called Rich Dad, Poor Dad, And he really didn't have two dads, but one was it was metaphorical. One of his mentors was rich, and his real dad wasn't. And so he talks about in the book how one of them wanted to pay off the home loan so that they didn't owe any money. And the other one never did, never wanted to pay off the home loan. And the question is, the dad that did not ever want to pay off the home loan, was that the poor dad or was that the rich dad? And the answer is that was the rich dad. And the reason is because there's this concept called trading on equity. Now, right now, let's say interest rates are at 5%. That's a lot. How much is property appreciating by? Last year, it went up like over 20%. So if property is appreciating at 7, 8, 9, 10% a year, but interest rates are only 4 or 5% a year, then it makes more sense perhaps to take your money out of your house, get a loan against your property, and use that loan to buy another property, right? Because appreciation is greater than interest. Now, if you have 100% equity, then that's great. You don't have to make a loan payment, but that money is not something that you are using, and you could borrow against it and use the money to buy something else, which is now going to appreciate. That's the theory. A balloon payment is defined by law as any payment greater than twice the amount of the smallest payment. Overtime may be unimportant because there's no guarantee you're going to get it. Borrower's need is unimportant because they don't really care, they being the lender. The word seasoned means it's been around for a while, right? And the payments have been made, and that's called seasoned. The word season also applies to how long the money has been in your bank account, but when they're talking about a seasoned loan, it means the payments have been made for a long time. The larger the down payment means that you're probably going to be more reliable, take better care of the property, and receive a lower interest rate. People sometimes ask me, what are today's interest rates? It all depends. It depends on the kind of property you're buying. It depends upon your credit score. It depends sometimes on the zip code you're in. It also depends upon the amount of down payment, because the more money you have down, the safer the lender feels, the better they sleep at night. They charge a lower interest rate. The lower your down payment, for example, you can buy property with 5% down. Well, that makes the lender a little more nervous, and generally there's a high interest rate. Sales financing, refinancing, and construction financing is where money demand for money is. Neighborhoods have effect on appraisal. The Equal Credit Opportunity Act says that lenders cannot determine a borrower's creditworthiness on sex, marital status, family planning, or part-time income. And according to the California Civil Code, a mortgage payment is not late unless it is received more than 10 days after it was due. A lot of times I have people saying, well, I don't understand because my bank says I can have 15 days. Yeah, that's not relevant to the Civil Code. But what the Civil Code says, they are not allowed to charge you a late payment unless it's more than 10 days late. Not allowed. But that doesn't mean that they can't give you longer. And sometimes they do that just so they look good, but they want a little bit of a buffer so they don't get in trouble for charging a late payment when it wasn't late by statute. If the lender wants the borrower, this is called compensating balances. So this is where I go into a bank and I say, I would like, I'd like to get a construction loan. I hear you guys make construction loans. And the bank says, yes, we make construction loans. By the way, are you a, depositor in our bank? And I'm like, no, I just need a construction loan. And the bank says, oh, really? And so where do you put your money? Oh, I have a, local bank that I really like. That's what I use. I'm just here to get a construction loan. And the bank says, oh, have you ever considered maybe, opening an account with our bank? No, I'm happy with my bank. I just came to you for a construction loan. Well, if you're so happy with your bank, why don't you ask them for a construction loan? Well, they don't actually make it. You see where this line of conversation is going. Pretty soon the bank says, how about this? Why don't you open an account here? You know, if you want us to give you a loan. And we're going to ask you to put a certain amount of money in that account. And you're going to sign a piece of paper that says that if you should, I don't know, forget to make payments to us, then we can just take the money, out of the money you've got in the bank account. How about that? If you really, really want that construction loan. That's called extortion, compensating balances. If a person is not given a loan because of what the credit report says, and then they don't get a copy of the credit report, $5,000 plus attorney's fees. A mortgage loan is a loan collateralized by real property, right? That's a line right out of the state exam. It's an answer. And collateral comes from two words, col and lateral. Col means along and lateral means to the side. So a loan collateralized means that real property is the security for the loan. Collateral means security. And mortgage yield is interest, not principal. Getting the money back is just getting the money back, right? That's not a profit. The yield, the profit is interest. Loan costs, interest. Lots of things affect the interest rate. How much money is available, the neighborhood, the amount of the loan, the borrower's ability to repay. The amount of money available or the condition of the money market is the most important concern. Interest is rent for money. What would affect house rents? If there were more houses to rent, wouldn't that often make rents go down? If there were less houses to rent, then rent would go up. If there's more money to rent, rent goes down. If there's less money to rent, the rent goes up. Interest rates decline when the supply of money increases. And it's affected by demand, inflation, and monetary policy. Impounds. A impound. Have you ever had your car impounded? Now, even if the answer is no, congratulations, by the way, but even if the answer is no, I'll bet you still know what it means, right? If they've impounded your car, they're storing it for you. Isn't that what they're doing? Right? Keeping it safe, right? It's behind a fence with razor wire on the top and snarling dogs running around. Speaking of dogs, has your dog ever been pounded? What are they doing? They've impounded your dog. They're storing your dog, right? So you come in and get your dog. So an impound is a storage device. It's like a reservoir, a reserve, like a reservoir. So we have a little river. We build a dam. A reservoir backs up behind the dam, which gives us water to use in the future. In a loan, you have a stream of income that's your payment to the lender. The lender is going to make a dam and allow a reservoir to build up of your money that they're storing, impounding, to pay bills of yours in the future. Let me say it this way. Impounds are money the lender collects from the borrower, but the money does not belong to the lender. The lender doesn't get to keep it. What would be an example? Property taxes, fire insurance premiums, special improvements, which are a type of property tax and homeowner association dues. Some people miss the homeowner association dues, which means you haven't gotten a loan on a common interest development. And that's because homeowner association dues are based upon the CC&Rs, the conditions, covenants, and restrictions, which were recorded before the loan. In other words, if there was a fight over the property, the homeowner association has a superior lien than Bank of America, a better lien. So what an impound is, they first of all want to fill up the reservoir. So they want you to put into escrow maybe 6 months of property taxes, insurance premiums, special assessments, and homeowner association dues. And then every month when you make a payment, in addition to the principal and the interest, you're paying property taxes, insurance premiums, and homeowner association dues. Interest is not paid from this account. So PITI, old school kind of a phrase, principal, interest, taxes, and insurance, right? And we also could add in homeowner association dues, which would be PITI8. Well, PI, the principal and interest is servicing the debt. It's not an impound. Impounds would be taxes, insurance, and homeowner association dues. What's the difference? Principal and interest is money that goes to the lender. It's their money. They can spend it on anything they want to, but they can't spend your impound account on anything they want to. The lender can only spend the money in the impound account for property taxes, insurance premiums, or homeowner association dues. So another way to put it is interest is paid, but it's not impounded. Impounded means it's grabbed and stored and put to a side in order to pay a bill of yours in the future. Interest is paid, but it's not impounded. A discount point also used to be called a buy down. And what a buy down is when you, and this, by the way, is probably going to become more prominent. Let's say you've got money, but not a lot of qualifying income. So if interest rates go up, you see the ratio doesn't change, right? The 40% ratio doesn't change. Your income probably doesn't change. How many of you have a job where it's written into your employment agreement that if inflation goes up, if interest rates go up, you automatically get a raise? Anybody got that in your, interest rates go up, you get a raise? Nah, I've never seen it. So interest rates are going up, but your income is not going up and the ratio has not changed. So that means that 4,000, 40% of 10 is 4, that $4,000 payment. If interest rates go up, then that means a greater amount of that payment goes to interest and the smaller amount goes to principal. The rule of thumb generally is that if interest rates go up 1 point, it lowers your purchasing power by 10%. But let's say you've got cash. You can buy down your interest rate by prepaying some of the interest. So a discount point is prepaid interest. And each point would change your interest rate by 1/8%, roughly. So each point charged, the lender collects 1% of the face amount of the loan. It could be deducted from the loan proceeds. Normally it's not. In a tight money market, and by the way, on the state exam, tight money means high interest rates. Points tend to increase. And loans are assuming the loan doesn't have a due on sale clause. And a discount loan is just a definition, never heard of one in reality, but it's a loan where all the interest is collected in advance. Again, something they found in a textbook. Lenders may have other requirements. Termite inspections and things like that are required on FHA loans and VA loans, but usually not required on other loans. You also might pay a loan origination fee, which is also usually a percentage. I've had clients say, they see this on their buying closing statement, What's the loan origination fee for? And my answer is it's for the pleasure of doing business with that lender. That's what it's for. And you can't charge people different amounts simply because they don't speak English. And you say, you'll sign here, okay, right here, initial, okay, great. Can't do that. Construction financing. The construction loan is an interim loan. Construction loan is an interim loan. Then there's a new buyer gets a takeout loan. So some years ago, I had a guy who was a contractor, Jesse. And Jesse was a spec builder. So Jesse is driving around over in Santa Cruz County, and he was in Aptos, and he saw a parcel of vacant land for sale. Now, this is a long time ago, but that land sold for $1.2 million. This property, this lot, this was an unimproved lot, was under 10,000 square feet. Under 10,000 square feet, $1.2 million a decade ago. Why? Two reasons. Number one, why was it worth so much? One is the owner had gotten what are called the entitlements. And when you hear that term in real estate, it means the owner had submitted architectural plans and to the county or the city, and they had gotten full approval to build. You know you can build in what you can build. The other thing is that this lot was walking distance down to the beach in Aptos. Walking distance, $1.2 million. All right, Jesse needs to buy the land. But then Jesse also needs to build the house that the architect drawings have. It was a Tuscan style villa, is what the owner had gotten approved. The loan to build was $3 million. So Jesse and I show up at a bank in Santa Cruz. It was a nice summer day in Santa Cruz. Jesse drives up in his pickup truck. Literally, he's got the golden retriever, in the back. And Jesse walks up, to go in with me to the bank. And Jesse was wearing a tank top t-shirt and cut off jeans. And I made a comment to him. I said, look, I realize we're in Santa Cruz. I grew up here too. But you're looking for over $4 million in financing. I mean, you could have worn pants. I mean, that's all I'm saying, right? You could have worn pants. But the bank didn't care about Jesse's lack of pants. They didn't even ask Jesse, well, how many homes have you built? And did you have any references? They didn't ask him that very many questions. They were actually more interested in me, which might seem odd, but the reason I was there is that I had a doctor who is ready to buy the completed property for $6 million if it was built. That's what the lender wanted to hear about. The doctor, the name of the doctor, I got a letter of intent. Can we talk to he's lender for the doctor? Yes, you can. There's a letter from the doctor's bank, right? Yes, and they're focused on the doctor, right? Because as long as Jesse could build a house, it was going to sell, it would be sold for enough and everybody would get paid. So the first loan is the loan to buy the land. The second loan is the loan to build. The loan to build is bigger than the loan to buy the land, which is why the loan to buy the land would have a subordination clause that gives a priority to the loan to build. Again, why would the lender do it? Because if the lender wouldn't do that, then Jesse will never get a loan to build. And if Jesse doesn't get a loan to build the Tuscan style villa, then Jesse will never sell the property to the doctor. And if Jesse doesn't sell the property to the doctor, Jesse's not going to ever be able to pay off the $1.2 million loan, right? There's no reason to lend Jesse $1.2 million to buy the land if you won't subordinate to a construction loan because you'll never get your money back. The reason the loan to buy, and one thing you could do, I didn't do this on this one, but if we drew a line and the line would be right here. And the reason the line is right here is these two loans were made to Jesse. This loan is made to the doctor. And the reason that third loan is called the takeout loan, because that loan is going to take out, pay off the first two loans. You need to know those terms. A construction loan is interim. Interim means it's a short-term loan. Jesse hauled over to that house to start building, right? Because the meter was running. You'd think that that bank just gave Jesse a check for $3 million. Go build. I wouldn't have. No, they're not going to just give you a check for $3 million. They're going to parcel it out, right? It's called draws or an obligatory advance. So as an example, he got 20% when he put up the subfloor. That means the foundation. First thing Jesse did is he went to the land, he cut the earth, he laid the foundation. The bank sends somebody out. Okay, check. They gave him the first 20%. Then now he's rolling. When the walls are up, he calls the bank. They come up, walls are up, they give him another 20%. When the roof is up, they give him another 20%. When it's completed, they give him another 20%. But that's not 100%. The final 20% they're hanging on to is until all of the lien rights from the subcontractors and everybody else is expired. Then you get the last payment. Those are called advances. Something different. Subdivisions. There are actually 3 laws relating to subdivisions that could be on the state exam. 2 of them are state laws. 1 of them is a federal law, which we're going to mention a little bit. There is the Subdivision Map Act. And the MAP Act is a procedural law. It's procedures developers must follow. Then there's the Subdivided Lands Act. That's consumer protection, and it requires disclosures. We're going to start with the MAP Act. The MAP Act gives local authorities, usually the Planning Commission, control over the physical aspects of the subdivision. How wide are the streets? Where are the easements, sewers, etc. The definition of a subdivision for the MAP Act is 2 or more parcels. 2 or more. Any lot split in California requires a map. Any lot split. 1 lot split in 2, you got to go to the Planning Commission, you got to file a map. It controls all subdivisions, 2 or more. It gives local governments the power to regulate subdivisions. They have to show that it's complying with the plan, that they've got utilities. It applies to all subdivisions of land into 2 or more parcels. It doesn't apply to property located outside of the state. So if I'm in San Jose, California, and I'm selling Nevada timeshares, does the San Jose Planning Commission care? And the answer is no. Why would they care? They're in Nevada. They don't care. Okay? That may seem obvious, but we'll get back to that point. There's a planning commission. Everybody has to have one. They have master plans. It shows the freeways and things like that. Basic tool historically is zoning. Basic tool. And what zoning means is districts. Traditional zoning. Here's a residential district, here's a commercial district, here's an industrial district. Now, there are questions on the state exam about what's different in terms of an alternative to traditional planning using zoning, and it's called form-based planning or a form-based code. And it fosters predictable built results and high quality public ground by using physical form rather than separation of uses as the organizing principle. It's a regulation. All right. You might have heard that there's a housing shortage in California. Right now, if I bought land in a downtown area and I wanted to put in retail shops, many cities are going to require multifamily units up above. they want to see housing up above. Now, you understand if residential and commercial are two different districts, which means they're two different geographic areas, then you don't have residential and commercial in the same spot. How many of you know shopping centers, shopping areas where there's condos or townhomes already built in? Way more common. And given the housing shortage, many of the regulations are being changed to not only encourage that, but sometimes require it. That's form-based, not districting. Here's residential and here's commercial. They're mixed together because we need to build more houses. Now, there's different kinds of map. There's a parcel map, which just gives you the location of the parcels, a tentative map, and a final map. The requirements, and by the way, the tentative map is a little more difficult. Sometimes I've done a lot of land transactions. The agent that's representing the seller will just say tentative map required, just so you know, right? And the tentative map requires a lot more details. The legal description, proposed boundary changes, location of utility easements, widths of street, water supply, all that kind of stuff. And if you turn in your map, and yeah, they kind of look like a map. They either approve the map or they reject the map, and they rarely just approve the map. It's possible, but that usually they want to tweak it just so, you know, it looks like they're doing something. So they'll say, nah, we don't like the way the streets are laid out. No, we want to see some place for, you know, a little park or something, you know, change your map. And eventually you come up with a map that they like. And then once that map is approved, you have 24 months, 2 years to do the final map. No contract, no lease, no sale is valid until you get a final map. Now, if you only have 2 to 4 lots, you only need to do a parcel map typically. If you're doing 5 or more, they want a more complicated map. A second law is called the Subdivided Lands Act, and it's to protect California purchasers of subdivided land from fraud. So there used to be this ad on television and whatever, and it was involving an actor. He's still kicking around doing stuff. His name is Eric Estrada. And Eric Estrada, a long time ago, was in a TV show called Chips about highway patrol motorcycle cops, right? That was the show. And so in the commercial, Eric Estrada is standing in front of a bunch of trees, and what he's pitching is a subdivision at Lake Shastina. Now, you've probably heard of Lake Shasta. Lake Shastina, that's not Lake Shasta. I don't think you can even see Lake Shastina from Lake Shasta. So he's talking, you know, this is, you know, history in the making, ground floor opportunity. And there were drawings, right, that they would show of what the boat docks were going to look like, and the community centers and the community pool and the artist drawing of children, you know, running up and down the community place and boats in the ocean, I mean, in the lake and all that sort of stuff. Now, the problem is that none of that stuff was built. None of it existed. And so if you bought a lot at Lake Shastina, you're hoping that that subdivider actually puts in the roads, sewers, electrical, water, all that other stuff. But if they fold, and by the way, they folded, but if they fold and they don't have the money to do all that stuff, and there's never any boat docks and none of that stuff ever exists, you could be ripped off. I actually was teaching a class, and some people, a woman came up to me. She said, I don't believe that Eric Estrada would sell worthless land. I don't think they must have built all those things. And I'm like, you know, lady, explain this to me. If they had built anything, why was he standing in front of bushes? Right? You understand? If they even had a gate that said Lake Shastina, I'll bet he would be standing in front of the gate. He was standing in front of trees, because that's all there was. This includes out-of-state subdivisions. If I'm selling Nevada timeshares, although my city's planning commission may not care, the Department of Real Estate does. If I'm selling Nevada timeshares, is there a good chance I'm ripping off people? There's a pretty good chance. In fact, the Department of Real Estate requires a special permit to sell out of it. So let me put it this way. To the Department of Real Estate, they do not care where the subdivision is located. It does not have to be in California. It does not have to be in the United States. All they care about is you're in California selling it. And if you're in California trying to sell it, you need to go through this process. The definition for the Subdivided Lands Act is 5 or more parcels, 1, 2, 3, 4 units. You don't have to go through the Department of Real Estate. It does not apply if the parcel is 160 acres or more. Why? Because normal people don't buy 160-acre parcels, right? People that buy 160-acre parcels should know what they're doing, or they shouldn't be buying it. And the protection is really for normal people, amateurs buying property. The procedure, you have to give all this information to the Department of Real Estate, maps, financing documents, contracts. How about this? Financial arrangements to assure completion of community recreational facilities. Yeah. How about this? Proof that the parcels can be used for the purpose for which they are offered. That would seem like a good idea. So that's part of the requirement. The process is you start by getting a preliminary public report, which in the business is called a pink sheet because it's actually printed on pink paper. When it is issued, you can accept deposits with reservations, but you cannot sell. Deposits are refundable during the preliminary public report period. It's valid for 1 year or until you get a final public report. After the year, you get a final public report. Now, notice it says that the subdividers have to give a copy to a prospective purchaser. They have to allow them time to read it, and they have to get a receipt. They also have to they must give a copy to anyone who requests it. They have to use a special form for the receipt. They have to keep it for 3 years. They have to post it in their office. Are you getting the feeling that they don't trust subdividers? I don't know if you're getting that feeling, right? They don't trust subdividers. If there's a material change, you got to get a change public report. Changes in the lot size, changes in the documents, a sale or option of 5 parcels to 1 person. Why? Because if I sell 5 lots to 1 person, by definition, they're a subdivider because they now have 5 or more new conditions affecting the use or the value, but not a change in price. This may seem odd, but a change in price is not a material change. And that's because the Department of Real Estate doesn't know what a good price or a bad price is. They don't have any idea, so they don't care about the price. That may seem ironic, but they don't care about the price. If the report is used in advertising, they can't just take snippets out of it or quotes out of it. They have to use the whole thing, which means nobody ever uses it because they're very long. Again, they don't trust subdividers. Subdividers, however, can list the property and make improvements. They just can't sell it or they can't take deposits until they get the preliminary report. And they can't have a closed transaction until they get the final public report. The Department of Real Estate would issue a desist and restraint order if you were ignoring their rules. And if they took you to court, they would take you to Superior Court. A blanket encumbrance, I talk about that also in another class, but that would be like a construction loan affecting many of the lots. And the commissioner often requires that the money be impounded unless that lot is released from the blanket encumbrance. I don't know if that went over well. So let's say I've got like 20 lots, I'm a subdivider, and I have a $12 million construction loan. Right. So that $12 million construction loan is on all 20 lots. So if you buy one of my lots, first of all, you're probably not going to get a loan unless I can release the lot from the $12 million encumbrance, right? You know, the construction loan, because the lender is not going to lend you $800,000 to buy a house that has a $12 million first on it. I mean, they're not going to do that, right? So if they can't release your lot, then they don't want the subdivider to spend the money you gave them. They may require it to be impounded. Right. Liquidated damages. For sales of subdivision interests, the liquidation damages a subdivider can collect is limited to the amount on deposit advanced by the buyer. This is something the Department of Real Estate has been picking at more recently than before. And I'm going to make like a little graph, chart, table, something like that. There are two liquidated damages rules. One of them is in front of you. The other one is contained, we're going to talk about it when we get the purchase agreements. If this is a residential resale, so I'm selling a home that I already own to a buyer, owner occupied by the buyer, buyer's going to move in, 1 to 4 units. California Civil Code says the most I can charge for liquidated damages is 3%. Now, what liquidated damages means is that you forfeit your deposit if you can't close. If you're the buyer and you put down a 3% deposit, and that's why 3% is what is often asked for in residential resales, because that's the most the seller can keep. California Civil Code says 3% is the most that the seller can keep of the buyer's deposit if the buyer defaults under California law for resales, 3%. Now, subdivisions, which are regulated by the public report system, are not part of that 3% rule. And for subdivisions, they can ask for 5% down, 10% down, 20% down, whatever they can convince people to put down. And what the liquidated damages clause for new home subdivision says, they can keep your deposit, no matter how much it is, but they can't sue you for any more money. So if you bought a $2 million brand new home subdivision and you had a $100,000 deposit and you walked away and the subdivider can't sell it to anybody else and they got this big, they can't sue you for $2 million. All they can do is keep your deposit, but it's not limited to 3%. That 3% limit is only for resales. A land project would be like Lake Shastina, big, more than 50, unimproved, vacant land for residential in an area that's sparsely populated. If you lived near Lake Shastina, would you vote to have your property taxes increase so they could build this subdivision for people? Probably not. You see, if there aren't many people living in the area, there isn't a tax base to do anything. So this has a 14-day rescission period. You get 2 weeks to sober up and come to your senses, and you can get out of a contract. Then there's the federal law. The federal law is the Interstate Land Sales Full Disclosure Act. It's known as ILSFDA, which, sounds like a German opera singer or something like that, anyhow, it's a federal law. And the Department of Real Estate doesn't ask as many questions about this because they like their law better than the federal law. It applies to subdivisions as 25 or more unimproved lots. Interstate commerce. So the only time ILSFDA applies is when we're talking about lots in other states. So they're marketing it in California, but it's another state. Buyer has 48 hours to rescind. Now notice under the California law, you have 2 weeks. Under the federal law, you have 2 days. State likes their law better. Types of subdivisions, there's a standard subdivision, a common interest subdivision, Common interest would mean a condominium or a planned unit development, which is also called a PUD. And there's another word which isn't going to be an answer on the state exam because it's not a legal definition. But if you wanted to know, if you were on Zillow, if you were searching through the MLS, what would you look for? Because they don't say planned unit development usually either. It's a townhouse. What's the difference between a condo and a townhouse? And the answer is, in a townhouse, it's 2 or more levels and you own the land. Generally the definition, that's a planned unit development. Condominium, you don't own the land. So an undivided interest, I know the first one looks like a flag of somebody's, but if I take one lot, that's the blue one, and I divide it into 4 lots, that's a standard subdivision. If I have, this is the one in the middle, the green and the orange, if I have a building and I divide the building up to individual units, the land is still owned in common, that's a condominium. And interest would be something called a tenancy in common, which is a type of subdivision, and that's going to come up soon. So types of subdivisions: standard, common interest, planned development, timeshare, and undivided interest. Standard is 5 or more, improved or unimproved. A planned development is similar, except there is an area owned in common. So some places you have single family homes detached, but there's a swimming pool, there's a playground, there is a homeowner association. That's called a planned development project. Common interest development, SIDs, are condos, PUDs, townhomes, stock co-ops, community co-ops. And this was on the, like a line from the test, owners of a condo, a PUD, and a co-op all own a common interest in the airspace above the common areas. Why they thought that was something to ask about, I don't know, but that's the answer. So a condominium, usually condominiums are apartment buildings that have been converted. If you buy a condominium, you get a deed to your unit. You have a fee simple estate and you own the airspace in the unit. It's an interesting thing. What do you own in a condominium? And the answer is you own from the paint to the paint, right? The airspace in the unit. But you have an undivided interest in common in the common areas. Bearing walls are the walls that hold up the building, elevators, sidewalks, land, and things like that. Each unit would have, if you had remodeled your kitchen in your condo and you didn't pay the contractor and the contractor filed a mechanics lien, it would just be on your unit. If you had property taxes that you didn't pay, they would be on your unit. And you have a fee, already did that. And the HOAs are limited to how much they can increase. And seller must give the buyer a copy of the bylaws, the CC&Rs, and the financial statement of the homeowners association. Now, a community apartment project. These are bigger back east. I'm in Northern California. San Francisco has these. San Francisco has co-ops. Now, the difference between a co-op is when you buy into a co-op, you end up with an undivided interest in the total property, usually as a tenant in common. So you're given a unit to occupy, but you do not have a deed to that unit. You don't have a deed. Your property tax bill is not on your unit, it's on the whole property, and you're asked to pay your part. The loan is on the whole property, and you're just like part of that existing loan. If there was a mechanics lien that because you didn't pay to remodel, you didn't pay the contractor, it would be on the whole unit. Notice the difference. In a condominium, you actually own your unit. You have a deed to your unit. You have a loan on your unit. You have property taxes on your unit. In a co-op, all those things are on the whole property. You're just given a portion of it. One's equity might be lost if other lessees or other people, they're sometimes called lessees in a community apartment project, default on their payments. A stock cooperative, I've sold one of those. They look like condos. By the way, community apartment projects, you say, what do they look like? They look like condos, right? Stock cooperatives look like condos, and it's a twist on the community apartment because there's a corporation that owns the condominium building. And then when you buy stock in the corporation. So the buyer receives shares of stock. You don't get a deed. I sold one of those and the buyer's like, so we're gonna get a deed. No, you're not gonna get a deed. You're gonna get stock. I know, we're gonna get stock and a deed. No, you're just gonna get stock. Well, how do we show we own the property? Well, you show people your stock. Well, what do we want to sell the property in the future? We have to sell your stock. I don't know. But those are older forms. Most people go for condominiums or planned unit developments these days. A timeshare, that's when you've got 1 week in a condo in Cancun or something like that, right? And then your week turns out to be hurricane season week, that sort of thing. But anyhow, in a timeshare, we're not dividing the land up. We're not dividing the building up. We're dividing the ownership by time. And under California law, there's a 7-day right to rescind. And if you sell, remember Nevada timeshares, if you're selling Nevada timeshares, you need a special permit from the Department of Real Estate. They are closely scrutinized. And the subdivider has to file what's called consent to service a process so that subpoenas can be delivered to the Secretary of State. Here are the two big ones, right? The MAP Act and the Subdivided Lands Act. The MAP Act is in the government control code. Its purpose is to control the physical aspects. It's enforced by local authorities like the Planning Commission. The way they enforce the MAP Act is you've got to do what they want or they won't record your map. And if they don't record your map, you can't sell anything. The definition of a subdivision is 2 or more parcels and they don't care about out of state. The Subdivided Lands Act is in the B&P code, which stands for the Business and Professions Code, which is the code that regulates people with real estate licenses. And that section is enforced by the Department of Real Estate. Its purpose is to prevent fraud. It's enforced by the Real Estate Commissioner, which is going to give you a clue as to which of these laws the Real Estate Commissioner is going to ask you the most questions about. Probably their law. The way it's enforced is you got to get a public report to sell anything. And the definition is 5 or more, and yeah, they care about out-of-state subdivisions. The rest of this is sort of a bunch of things that have been on the state exam regarding subdivisions, which you should read, right? Short blocks are more expensive. Topography, which is the contours of the surface of the land, can affect how much it costs to build. These housing laws, building codes, building permits, they like to ask, where would you get them? And most people would guess it's probably from the local building department. And they establish minimum construction standards. They regulate, there's health officers that regulate a lot of stuff. FHA, GI, which means Veterans Administrations, and CalVet financing have minimum property requirements, which also regulate what you can build. Private individuals, this is a question on the test. If you wanted to build your own house, who would supervise construction? An architect is their suggestion. Developers are interested in topography and zoning and all that sort of stuff. The developer puts in streets, curbs, and gutters. The most stringent, the most restrictive restriction restricts, right? So if there's local and state and federal, whichever is the most restrictive is the one you have to meet. There's building codes, zoning laws, government controls on health, fire, and buildings. Urbanization and industrialization is why we're doing this, because we're running out of room. There's a uniform building code. There's the California Environmental Quality Act, which exempts the conversion of rental units to condos. If you're speaking of that, if you're converting a condominium, you have to be given, if you're a renter, 90 days after the public report is issued to see if you want to buy the new condos. The word potable for water means it's suitable for drinking. And the Department of Real Estate wants to see that you got drinking water. What a thought. Federal law also regulates the R value, which is the resistance to the flow of heat in the insulation, and that's for every new home sale. You get a certificate of occupancy. That's when you can move in. And this is often on the state exam. What are the 3 phases in building a house? I've had agents over the years, people that have gone through my course say, when I ask them, is there anything on the state exam that I didn't talk about? They said, yeah, there's this question about the 3 phases of building a house. It's not in your outline. I'm like, yes, it is. And then I would show them, they'd say, well, you just put that in. I can show you a video that I made a long time ago. It was in it too. But, I'm just saying they like to ask, you buy the land, that's land acquisition. Development means grading and getting the lot ready to be built on, and then construction. An environmental impact report would give the environmental impact. And infill is vacant lots in urban areas where we're filling in empty lots. Could be commercial, a lot of times could be low-income housing. Smart growth is simply a term where it's incorporating green building practices, and it preserves open space, right? The Department of Real Estate has asked about that. There's the California Coastal Commission, which regulates subdivisions near coastal waters. Mellow roofs is a type of bonding system where it allows the subdivider to create these bonds that attach to the property. They're usually bought by investors, and then they can fund a wide range of things. The seller is required to tell the buyer about them. And a negative declaration is part of the California Environmental Quality Act. It's preferred by development applicants. It's usually issued by the California Coastal Commission. And what it means is that there's no perceived or negative anticipated environmental impact. It is not affidavits from neighbors saying they don't like what you're doing. So if I'm going to put in a subdivision, a small little subdivision next to the coast, I'm going to have to deal with the California Coastal Commission. That's a government authority. If I can show them that my little subdivision is unlikely to have any negative environmental effect, then they will waive the requirement for a full environmental impact report, which is something I would prefer. A green building is done to conserve natural resources, increase energy efficiency, and improve indoor quality. A phase 1 environmental, old questions used to ask about a toxic waste report. They don't call it that anymore, but it's called a phase 1 environmental. And it's related to something called maybe a brownfield, right? And brownfield sites are contaminated sites, right? So a brownfield is where expansion or reuse may be complicated by the presence of hazardous substances. Now, examples of hazardous substances are dry cleaners and drug labs and things like that. And petroleum sites also. There's a question on the state exam about somebody buying property that was either next to or was an abandoned gas station. And they ask on the state exam, what would the buyer want? And the answer is a phase 1 environmental. That's the report they would want. And in order to clean up some of these sites, the Department of Housing and Urban Development has a grant program that provides money to do this. And the Department of Real Estate asks about that. Pretty much that paragraph there says what they ask about. And it's a way to, develop land, and they can build low and moderate income housing. And that brings us to an end for tonight. We've gone through quite a few different things. And what we're going to do now is we're done with this part. I'm going to explain how the course works. If this is your first class, hang on. If you're about to take the state exam, and I invited you to check out the class because I have a workshop coming up, there's some parts of this that you might find useful. But let's talk about how you get a real estate license. For those of you that don't already know, in order to get a real estate license, there are 3 things you have to do. 1, you have to complete 3 college level courses in real estate. You don't have to go to college. They're all included in our program. 2, you have to pass a test given by the California Department of Real Estate. And number 3, you have to apply for a license. Now, the 3 college courses are real estate principles, real estate practice, and an elective. The elective could be anything from this list. Notice that accounting, economics, and business law is on the list, which means if you've ever taken those classes from a junior college or better, you have the elective course already. If you don't worry, we include legal aspects, which is real estate law, as part of the package. And that's the one the Department of Real Estate asks the most questions about anyhow. The courses, these 3 college courses, are designed, they're by a state-approved affiliate of ours, and they are approved by the Department of Real Estate to offer the 135 hours, 3 45-hour courses, right? And all of this is online. Notice the testing and grading is online. So there are 3 college courses, and that would mean 3 final exams. Your final exams for the college level courses are online final exams. You can take them at home, and they're open book tests. Let me go over that again. The 3 college level courses, there are 3 final exams. Each final exam is an online, at home, open book, cheat as much as you want to final exam. You can cheat as much as you want to. They give you 3 hours to get 75 out of 100 questions right. Did I mention that this is an open book test? Now, they make you wait 18 days before you can take the final exam. You don't have to take the final exam in 18 days. You just can't take the final exam any sooner than 18 days because it's supposed to be a 45-hour course. And you see, you could all pass tonight, right? If you enrolled in the course right now and then downloaded the book and took the final exam, they're going to give you 3 hours to get 75 out of the 100 questions right. You could look up 75 answers in 3 hours, right? Just cold, just looking through the book, just searching the text, you could find the answers, which would make the whole thing look silly, so they make you wait 18 days. That's the easy part of getting a real estate license. 3 online, open book, cheat as much as you want to, final exams. Hard part is passing the real estate licensing test. It's 3 hours and 150 multiple guess questions. And you have to go to one of the facilities of the Department of Real Estate. Fresno, San Diego, La Palma, which is in Orange County, but close to LA, Oakland, or Sacramento. You're not allowed to cheat. It's not an open book test. They're watching you. You have to get 70% or better to pass, which if you think about it, is not a particularly high score. You would hope your doctor passed their test to be a doctor by getting more than 70% of the questions right. Because at 70%, you've missed more than 1 out of every 4 questions. But you can get a real estate license still, because you don't have to be a brain surgeon, to get a real estate license. However, over half the people that take the real estate exam fail the real estate exam. Every time they give the test, more than half the people in the room are failing, many of whom they have failed before. You can take this test an unlimited number of times, What I do is I teach people how to pass the test. I have classes on Wednesday night. There's 12 of them, 6:30 to about 8:45, focusing on what's on the state exam. They're broadcast on the internet and recorded. They're like a pizza, warm and cheesy, and there's no first slice. They're all equally confusing at first. They're independent modules. They don't build on each other. You can start with any one, and once 12 comes, the next week is number 1. It just goes on and on forever. The investment in the whole program is $398. It includes the live classes, the video replays, the course outline. It includes practice testing, the college level courses, and a Saturday cram class. Now, I have really good reviews, right? That's an older screenshot. There's more than 43 now. They're in all the years that I've been doing this, since 20 years. Is that right? 2012, wow. 2000, well, I've been doing it but since 2012, when Yelp started, I started getting reviews on Yelp. In all that time, I've had one 4-star review. All my reviews have been 5-star reviews, and that's because I have a really high pass rate. Virtually everybody who goes through the course passes the real estate exam because I'm focused on what California asks about. You can sit through a class for free, and once you pass the exam, I'll help you get started in the business. I work with a company called eXp Realty. I have what's called a Mega Icon team, which I have agents all up and down the state of California. We're a cloud-based brokerage. Just saying. How long does this whole process take? Well, the college level course is 18 days, right? Before you can take the second one, another 18. So it's 54 days minimum to get through 3 college level courses. If you had done that today and you were applying to take the state exam, it would be more, usually right now, it's closer to 6 weeks before you could actually take the exam. And while you're applying to take the exam, you would have your fingerprints processed, which takes about 6 weeks. Once you pass the exam, they're going to take 2 weeks before they actually give you a license. You should expect at least 4 and as much as 6 months before you can get licensed. How much does it cost? The course is $398. To take the state exam and get a license issued is $305. Fingerprint processing and having your fingerprints taken is about $75. So $778 roughly gets you licensed. The Board of Realtors and the Multiple Listing Service, those are annual numbers for what that might cost. After you get your license, it's good for 4 years, and every 4 years you have to renew it for 45 hours of continuing education for $245. And my website is dreclass.com. I need to, it's, and you click on the sign up for a free class button. And you'll see that there are several options. For those of you just getting started, it's the first option, $398. If you just want my workshop and the testing that goes with it, because you've already done the college level courses, that's only $99. If you have any questions that I have not answered, reach out to us. You can make an appointment to talk to me using my calendar link, call the office, send us an email. I would love to talk to you. That's all I got for this evening. Any questions, reach out to me. It's a good time to get into real estate, and hopefully I'll see you in class soon. Bye all.